Hey everybody, JJ here, bull boom, bear bust. It is Monday, March 9th. Record-breaking day, a lot of action in the markets. I don't think any one of you on this channel is surprised at what happened today. The stock sell-off was so great that we had to do a stock halt or a trading halt. And that's the first time that they had that circuit breaker triggered in over 20 years. Now, individual stocks had seen the circuit breaker go off for big sell-offs and also big run-ups, but this is the first time we saw entire exchanges get halted. Has the big fat ugly bubble popped? We're going to talk about that. The yield curve has inverted under 1% now for the first time ever, and prepare for more liquidity, a flood of liquidity, and more bailouts. We're going to have to see more bailouts with these banks. Let's get into it. Here is the end of the day bloodshed. Over 2,000 down on the Dow. That's a nearly an 8% drop. Same in the S&P, down 7.6%. NASDAQ 6.83%. Even gold did not find any safe haven buyers. If they did, then it was pushed back down through the paper market, through the futures market. Oil devastated, another 20% drop today, 27%. Cryptos got smacked down. Really no safe place for this unless you're a short seller, or unless you're on the sidelines in a money market or something like that. Probably the baddest part about all this is the individuals that saw their 401ks take a haircut over the past few weeks here. People that did not know that there was an alternative besides being in the stock market. Most 401ks and IRAs, retirement accounts, have money markets that are out of stocks that don't give you a very big yield, maybe 1% or 2% if you're lucky, but it sure beats having 30 or 40% of your 401k get wiped out. But again, I think most of you on this channel already knew this. We've been talking about this for a few years now. Now, I think Peter Schiff put it very well. This is a bubble that was going to pop eventually. Yes, maybe this infection outbreak and the panic that ensued because of that, maybe that caused the bubble to get pricked sooner than it would have otherwise, but something was going to prick it. If it would have been bank failures, like think back to Lehman Brothers failure before the financial crisis, right? Some other event could have popped this bubble, but ultimately it was going to pop. Now, is it popped for good? Are they going to prop it back up? Well, let's talk about that. Prepare for the liquidity flood right here. They are even admitting it, the Fed, to step up cash injections for banks to guard against market pressure. Now, as soon as these repos started happening back in about September of last year, we said there's major structural problems with the financial system, within the banking system, the fractional reserve system. And because of all the defaults that are happening, and because of the lack of oversight and the lack of regulations, the Fed injections are going to have to continue. We talked about that. We called that 6 months ago. All right, so it's no surprise. Did we know the exact event that was going to cause this to become Crisis 2.0? Well, we did not know exactly what was going to set it off, but again, we knew something would ultimately prick the bubble. It always does, and it always will. Now, it doesn't mean they're not going to prop this back up. We might see a recovery. Again, these are dead cat bounces a lot of times. They just want to sucker people into the market. Just look at last week. We saw a few big green days. We had the biggest green day, over 1,000-point increase in the Dow just last week, but followed by more sell-off. So there's not a dip in sight as far as individuals that want to buy the dip. At this point, even if there was a dip, considering this event, this global infection outbreak, I would not be even buying a dip, even if it did start appearing in the markets, until we get some sort of containment on this outbreak. And the news media, they love to push fear. If it bleeds, it leads. That's how it goes in the media and in the news. If it bleeds, it leads. They want to put out the most frightful stories. Typically, just think about over the past few years, all the events that we were warned about, nuclear war, you name it. Now, as part of continuing efforts, the Fed admits that they're going to make sure the funding and the repo markets are working properly. And the central bank said it's going to offer overnight repos now between 100 and 150 billion. Also, it's going to increase the 2-week repo operation offerings to at least 20 billion, up to a possible 45 billion. And I think before it's done, it's going to get much worse. I think we're going to have to do bailouts 2.0. Many people refer to these repo operations as bailouts since they are necessary to keep the banks liquefied and to keep the banks operational. Call it whatever you want. It is a rescue operation for the banking system. Let's take a look at today's repo action here. We had a total of 112 billion, just under 113 billion. So these operations are getting more intense. They're getting bigger, and that's because the entire financial system, the banking system, is flawed. This again has to happen. It had to happen eventually, and it looks like they're bringing the market down because now they have the cover, they have the excuse. The fingers are not going to be pointed at the financial system or the politicians and their policies. Instead, they can say everything was fine. It's this outbreak, this pandemic scare that caused everything to come crashing down. That way they can continue with all the failed policies that they tried before. They tried the bailouts. It may have worked temporarily, but it did not fix the underlying issue, which is the banking system, the fractional reserve banking system. And it's a system that based on, it's reliant on ever increasing amounts of debt to continue the Ponzi scheme, right? You see, so this is going to be the cover, right? We know that they do not want to take the blame. They're going to come in with the same failed actions that they did before. Bailouts, and get ready for bail-ins. They can just take your money now. If you're a depositor in a checking or savings account, that money is not yours. It's essentially an IOU is what the bank's going to give you if they take your money. That was actually made fully legal for that operation to proceed through the Dodd-Frank Act just a couple years after the financial crisis. Right? Maybe we'll see a combination of bailouts and bail-ins. Right? I wouldn't put anything past these market makers here that are behind this action. Let's take a look at a quick gold chart today. Gold saw a big sell-off at the beginning of the day. We did see a recovery towards the end of the day. I continue to have some bets in the gold and silver markets with the miners. Also accumulating physical as much as possible. I've got a link down there if you're interested. I don't recommend anybody to do anything, but if you're going to go into silver, be cautious. I mean, I personally am not very heavily involved in physical silver or in the miners because if we see deflation like we talked about in our previous report, ask yourself who's going to give you $10,000 for gold if it does go up, or who's going to give you $200 for an ounce of silver if we see deflation, massive job losses, foreclosures, and bankruptcies. What if we see metals also deflate? So I think it's a safe haven because it's kind of an insurance against hyperinflation, but I don't even look at it as an investment, more of an insurance policy against hyperinflation. Now, will we see hyperinflation? Well, we talked about that in our previous report. The dollar is still the king. It's the best house in the bad neighborhood. It's a highly flawed fiat currency, but that's where people run to in times of stress. So that's where I'm at, waiting for deflation. Could I be wrong? Could there be hyperinflation? Absolutely. That's why I try to hedge with that insurance policy known as precious metals. All right, here's another eye-opening event here. The U.S. yield curve plunged below 1% for the first time ever. Interest rates are going to go down. Mortgage rates are plummeting also. Let's take a look at some information. Quicken Loans, they are now seeing $4 billion in new mortgage loan applications. All these people that bought at the top of the bubble now are going to try to get a lower interest rate, of course, because this is the time. But I think rates could go even lower. Again, I expect 0 and negative rates unless there's some sort of debt elimination or debt default, and it's very possible the country could go into bankruptcy. Just take a look at Lebanon. They defaulted on their dollar-based debt. The U.S., we have, again, the unlimited credit card where the amount of money we can create is unlimited. So it's unlikely, in my opinion, that we'll see a default unless there's a structural change where the whole system gets reformatted, which I find very unlikely. All right, I know there's a few channels out there talking about such a thing, but if it sounds too good to be true, it probably is. They're probably just going to continue, again, the same failed policies. Nothing's going to change. The central bank, they'll come in and they'll pump in as much as they have to, and then they can point to themselves as the saviors, even though they are the bubble blowers that are behind all this mess that we're seeing right now. So is this the pin that's going to pop the entire economic bubble, or is it just a stock market panic that's going to be somewhat contained after we see more bloodshed here? Well, we'll have to find out. Right? A lot of it depends on the U.S. consumer. If the consumer pulls back, which they are starting to pull back on their spending, especially travel right now, if this panic continues, this is going to be economic collapse / financial crisis 2.0 unfolding right before our eyes. So again, try to stay prepared if you haven't done it already. Try to get stocked up on essential goods and items that you'll need. I personally have most of my cash out of the banking system right now. I do not trust the banking system with the whole bailouts and the bail-in culture that we've been in now for over a decade. They are further deregulating the banks, so not only are they not stopping the underlying problems, they're increasing the underlying problems. It's a big mess. All we can do is try to be prepared. In one of our next updates, I'm not sure if it'll be the next one, we're going to talk about how to prepare for recession even if you are broke. How can you prepare for recession even if you're broke? It sounds impossible, but there are ways that we're going to talk about. Thank you everyone for your support. We're going to sign off for now. I would say ride the bull. There's not much bullish action anywhere. Actually, some dollar stores and discount stores did see stocks go up in anticipation of very hard times for the consumer, but not much else bullish. Even gold and silver, like we talked about, cryptos, not much of a safe haven for now anyways. We're going to follow the trends for you. Thank you for watching this update. Prepare for the bear. Bye for now.